Trade Desk stock is down 72% in the past year. Let's see if this is a good opportunity to buy the company by looking at the fundamentals and running a DCF model to calculate the intrinsic value of the company and potential future returns. Very quickly, if you don't know what TTD does, they provide a platform for ad buyers. Most buyers are ad agencies, brands, or other technology companies, and they have seen amazing revenue growth in the past decade, growing from $113 million to $2.7 billion today. And analysts are still expecting a lot of revenue growth as they have the Trade Desk growing to $5.9 billion in 5 years. Their profit has also seen massive growth, especially in the past 3 years, growing from $53 million to $438 million. And one thing that I really like is that they have even more free cash flow, currently at $689 million. And because this is a software company, their margins are amazing, with gross margin currently at 78%, profit margin at 14%, and free cash flow margin at 24%. This is why analysts are also expecting a lot of growth in terms of profit, as they have the Trade Desk company making $1.78 per share and then grow to $4.30 per share in 2030. So if fundamentals are amazing, why is the stock down that much? One of the reasons is competition. For example, Netflix teaming up with Amazon in regards to ads. And other companies have done so as well. It is important to note that Amazon's advertisement sector is growing faster than the Trade Desk, at roughly 20% annually, while Trade Desk guided for 13%. And then, in order to determine the intrinsic value of the company and potential future returns, I use my Google Sheet. This tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And as you can see, the intrinsic value according to my low assumptions is $25 per share, middle $40, and high $61. And because the stock is currently trading at around $37 per share, this means that if my low assumptions occur, you would get a 3% annual return on your money, middle 11.5%, and high 19%. Now, as far as my assumptions, I assume they grow revenue between 8 and 14% annually for the next 7 years, the average of profit margin and free cash flow margin between 20 and 30%, and I assign the PM price to free cash flow at the end of the 7 years of 18, 20, and 22. Moreover, they are trading at a forward PE of 19 and price to free cash flow of 25. And I think we can conclude that the company is trading around fair value or even slightly undervalued. And they have a fantastic balance sheet with $1.4 billion in cash and $375 million in debt. And keep in mind, this is a company that now has a market cap of $18 billion. And in conclusion, I believe that the Trade Desk is a fantastic company with a great balance sheet and whose valuation has become a lot more attractive. However, it is not yet at a point where I see it discounted enough for me, but it's getting close. Lastly, if you want a discount on stockanalysis.com, grab my code in the description. I hope you found this video valuable. Let me know what you think about the Trade Desk stock in the comments, and I'll see you in the next one.